Michelle, how surprising is this?
To be honest, it's a bit surprising because the PBoC, they have emphasized that they are doing a lot of things to try to push the LPR lower. For instance, they have announced this guideline to say that they're concerned about the high deposit rate on structural deposits. So they're trying to ask banks to self-monitor themselves, to basically not to push the deposit rate too high. So all these things, and coupled with the targeted RR cuts announced last week, I would think that the improvement in the liquidity conditions would actually translate to lower LPR. So I think the unchanged figure means that we are likely to see an MLF rate cut pretty soon.
Is that what you think, Michelle, actually leads to an LPR cut once they start moving on the medium-term lending facility?
True. I think because the LPR is basically determined by the MLF rate with a spread. So as long as the liquidity conditions are not too tight, I think that should normally translate to a lower LPR. So over the first half of this year, we still expect them to cut the MLF or the 7-day reverse repo rate by 20 basis points more.
How much willingness is there from the banks now to call for a larger reduction like that, Michelle? Because their margins have already been squeezed as they try to combat this virus.
Yes, of course. So that's why policymakers, they have discussed whether they should also cut the deposit rate as well, so that they can give the margins, to protect the margins of the banks. But right now, I think the most straightforward thing to do is actually for the PBoC to cut the MLF rate. I think that's the most direct, the quickest way to actually translate to a lower loan prime rate. And considering that the Fed has already cut interest rates by so much, I would think that it's reasonable for the PBoC to also go and cut the MLF rate even more.
Yeah, and on top of not seeing any moves on the LPR, let's also remind, I guess our viewers here that they haven't actually come in and injected liquidity in some time. Is that a sign that things are actually much better on the ground in China than most people like us outside looking in actually think is going on?
I think given the developments over this week or even past week, I think everybody is now concerned about liquidity drying up, especially in the dollar markets. So I think for onshore, the foreign holdings of bonds and equities are not large. So I'm talking about the renminbi holdings in bonds and equities and other assets. So probably they are still not too concerned about that. But for myself, I'm more concerned about the dollar debt issuers, especially in offshore, because, of course, we've seen the dollar that have increased so much since the epidemic, and also the rates. There are also some signs of tightening in the liquidity conditions on considering the dollar. So I think, especially for real estate borrowers, we have seen the January, February home sales. They are really terrible. So if they cannot keep the sales up over the coming months, then they also have this concerns of whether they can refinance their short-term debt for the real estate borrowers, and I think that could become more concerning.
And you're still expecting a second cover recovery. I'm just wondering why, because we're now fearful of a potential second wave of infections and more imported cases coming into the mainland now. Wouldn't that delay any kind of quick recovery?
Yes. So in our central scenario, we did not foresee a second wave of outbreak in China. Of course, there's still a lot of uncertainty surrounding the situation. But if we assume that, yes, the policymakers can keep everything under control regarding the epidemic, then I think we are going to see some rebound in the second quarter, just because the first quarter is going to be pretty terrible. Right now, we have a forecast for the first quarter of -1%, but I think there could be some downside risk. We do not have a quick pace of normalization. We are still in March. I think the normalization in the activity, I would say, is probably not as quick as I was expecting. And then, for example, for the SMEs, the work resumption rate is standing at 60%.
Right.
And then after that, you have the global shock from the pandemic to the second quarter. And you also have the income and profit shock to domestic Chinese companies and households in the second quarter. So I would say that even though we will have a recovery over the second half, I think the risk is that the economy may not be returned to the optimal growth, which is around 6%, I would say, in the past.
Mm-hmm.